Good afternoon everyone, my name is Sneddon and I'm the Head of Portfolio Services here at InvestSMART, and this afternoon we're going to be going through why diversification for your portfolio is important, and also then take a deep dive into two of our model portfolios that we use here for diversification at InvestSMART for our clients. Now, of course, as we do go along with this presentation, it is a live Q&A. So you supply the Qs, I supply the As, and away we go. So just below the video box there on your screen, you'll see a box there where you can put in your questions. You send them through, and once I've finished the formal part of my presentation, or once I've gone through all the slides, we will take a look at the questions and hopefully I'll be able to answer them all. If I can't answer them though, I will definitely get back to you as soon as I can. So before we do get into it, the most important slide I've got all day is our disclaimer. Now, we will be talking about general investment advice, and we will also potentially go into the realm of talking about exchange-traded funds, maybe managed funds as well, maybe one or two companies, depending on where your questions do go. So just keep in mind this is general advice only, and of course we don't know your specific personal circumstances. So if I get a bit too carried away, we might even put that disclaimer back up later on as well. So just going into what we'll be covering today, this first slide just shows us that we're going to go through a reminder of the diversification and why it's important, and also the importance of rebalancing your portfolio as well. I will go into demonstrating how we select the individual exchange traded funds that we use for our diversified portfolios. So how do you differentiate between 3 ETFs that all track the same index? Which one do you go for? That's what we'll jump into and have a look at. We'll then go through a full breakdown of 2 of our investment portfolios. We'll then go across, of course, the general investment structure of the separately managed accounts that we operate here. And of course, we'll talk about how you can tie these in potentially with our intelligent investor hand-picked stock portfolios as well that have been performing really, really well. So, and of course, after all that, we'll talk to you and we'll answer your questions as well. So let's get into it first and foremost. Now, why does asset allocation matter? These slides here are a little bit old now, actually. I've been doing this presentation for well, a couple of times, but they originated from the last roadshow that we did in Brisbane, Melbourne and Sydney, and they come from our CEO, Ron Hodge. And Ron got up there and just presented why a diversified portfolio really matters, and he used these next few slides, and I thought they were really important, and I wanted to use them again just to reiterate the point and why a diversified portfolio actually really matters and works over the long run. So the very first slide here, and as I said, this data is a little bit old, so these performance numbers have changed a bit, but the point still remains the same. This is the 1-year relative performance figures for various asset classes. So on your right-hand side, you've got cash, you've got fixed interest, you've got property, you've got international equities and Australian equities. So they're the most common asset classes that we see getting around today. Then on the left-hand side of the screen, you've got diversified portfolios. So these are just simple diversified portfolios that we've grabbed from the Morningstar side of things. And you can just actually see how each of those diversified portfolios, so conservative, moderate, balanced, growth and high growth, have gone over the years. So they're made up of all of the portfolio, all the asset classes on the right hand side. So of course, a more conservative or moderate portfolio is going to have more exposure to cash and fixed interest than of course the growth portfolio. So that high growth portfolio, you're looking at that to be made up of higher proportions of our growth asset classes, which are property, international equities and Australian equities. So that's what's in those portfolios on the left hand side there. So you can see over the last 1 year, Australian equities had outperformed. That's probably changed a bit right now, actually. I think international equities has outperformed since when we originally put these slides together. But you can see if we go forward into taking into consideration 2-year figures, property was definitely the most highest performing asset class across this period, so outperforming international equities and Australian equities. And of course, as we would expect, cash and fixed interest trailing the two. Now we jump forward to the 5-year figures, And you can see here that international equities has started to take its role as the leader here. Property second, Australian equities third, and then of course cash and fixed interest down the bottom there. Now, as we're going through here, as you can see, the average returns are starting to even out across the other portfolios on the left-hand side, the diversified portfolios, keeping in mind they're made up of different combinations of cash and fixed interest. Now, jumping forward here, and this slide's really busy, our 10-year relative performance slide. What you can see here is actually over the 10-year period, and this is taking into consideration the GFC as well, this time frame. We've got here our fixed interest has actually been the best performer over all that time. So what actually happens in a diversified portfolio, you've got a lot more stability within these diversified mixed multi-asset class portfolios, and actually conservative has been the winner over this particular time frame. But you can see even down to diversified high growth, that still is in line and actually still almost better, or actually just marginally less off than the international equities side of things. And so what you're receiving here is a much smoother return, but you're actually capturing all the upside of those higher growth asset classes while still having the protection on the downside of the cash and fixed interest. And hence why these diversified portfolios over the long run have actually held up pretty well. So you're getting far less volatility in these, but also capturing the growth of those asset classes. So that's why we believe portfolio diversification is really important. So now I just want to talk about rebalancing these portfolios as well. So what I've got here is a balanced portfolio using our portfolio manager, Health Check. This was what a balanced portfolio would have looked like in 2001. You can see we've got the Australian equities in red there, the international equities in the orange. You've got a little slither of property in the middle, then you've got cash and fixed interest down the bottom. So 98% is a very good score. We generally say to people to rebalance your portfolio when it hits about 85%. That's when you should be looking to rebalance these asset classes. Now, let's jump forward to 2007. So 2007, the market has run incredibly strongly, leading into the GFC, of course. What we haven't done here is actually touched this portfolio at all. We haven't changed any of the asset classes. So because Australian equities and international equities had run so hard, they have naturally become a bigger portion or bigger percentage of your overall portfolio. So as they grow, the cash and fixed interest component as a percentage of your portfolio shrinks. And here we're seeing we're very much out of kilter from where we originally started. We've gone from 98%, we're now down to 73%. So what we need to do to bring this portfolio back into balance would be to actually trim 21% of the Australian equities holding, trim 8% of the international equities holding, and then just redeploy that between cash, property, and fixed interest. Now, in hindsight, if we were to do that at this point in time, we'd be adding more cash, we'd be taking away from equities, and that would be putting us in a better position for when the GFC actually happened. So that's why we say 85%. If we go back through a period of, say, last 20 years with a balanced portfolio, if we rebalanced every time it hit 85%, we'd actually only be rebalancing on 4 occasions, okay? So we're not racking up a huge brokerage bill, but we're rebalancing when the portfolio, to hit 85% and less, it needs to get out of kilter relatively significantly. And once it is out of kilter, we'd be topping up those undervalued asset classes whilst taking from overvalued asset classes. So if we go forward in this time frame here, and what we would have been doing is pouring out of Australian equities and international equities into cash and fixed interest. The GFC would then take place, and what would happen then? As the proportion of Australian equities and international equities that we had, as their value decreases, the value of, as a percentage-wise, of the cash and fixed interest component in the portfolio would significantly increase. And so what we'd then be seeing is we'd be out of sync again, and so we would be forced, if we were following those rules, to top up our Australian equities and international equities when the market was actually falling in the GFC. And so what we all know now in hindsight is that that would have been a pretty fortuitous time to rebalance your portfolio when that was taking place. And once again, we're not trying to be too clever here. All we're trying to do is rebalance our portfolio when our health check says we're out of sync. And so if we had done that, we would be significantly better off. So that's a note on rebalancing and why it is so important. So do jump into the portfolio manager side of things. If you haven't uploaded your portfolio there yet, do go and do so. Take a portfolio health check. Set your investment goal, which is based on time horizon, and then you'll be able to see how your portfolio stacks up. You might need to do a little bit of tinkering. Most people in Australia are underweight international equities and also overweight property. So you might have to do a little bit of tinkering there with your portfolio to get it above that 85% mark, to get into that 90% region. And then, of course, when it does dip below that 85% mark, then look to rebalance. Okay, so let's move forward here. And what we'll talk about now is actually our core growth portfolio. And I'll go through what we look for in exchange traded funds when we're selecting these, building this particular portfolio. So we've got the iShares S&P 200 index here for our Australian share exposure. The reason why we're using that particular ETF, well, one thing we're looking for, when we're looking for exchange traded funds, the basic index tracking exchange traded funds, what we want to find is the biggest and the cheapest. If it's the biggest, we're less likely to have tracking error. And so basically that's when tracking error is when the portfolio diverges from the actual index and has a different performance. So we want to get that the least amount possible. Now, of course, the reason why we want the cheapest fees, all things being equal with that tracking error, then an exchange traded fund will underperform its benchmark by the cost of its fees. So the iShares S&P 200 Australian share index is the cheapest out there right now. And so that's at approximately 0.15% management expense ratio. And that's why we've gone for that. So when you go through here, you'll see a number of names consistently popping up, being iShares and Vanguard, and they are some of the biggest here in Australia, and the cheap, and therefore also the cheapest at operating these exchange traded funds. So we've got the Vanguard All World ex-US shares index. We've got the iShares S&P 500 exchange traded fund there as well. We're getting our European exposure here through the Vanguard Europe shares index as well. So we're getting broad-based exposure there. Now, just point out the iShares S&P 500 exchange traded fund, quite a large fund, and therefore, because of that, the management expense ratio is absolutely rock bottom. I don't think you'll find a cheaper ETF out there than iShares S&P 500. If you can, send it through to me. I'd like to see it. Then going forward here, we've got some property exposure as well in this particular portfolio. We've got the Vanguard Australian Properties Securities Index. We've got for a bit of diversity in that property side of things, we've actually got the Van Eck Global Infrastructure exchange traded fund. So that's investing in global utilities like toll roads, bridges, power suppliers, etc. But because that's a little bit more exotic, you can see the management expense ratio on that is a little bit higher, 0.52% per annum. We then, for our cash, and this is something that people might be interested in, AAA, which is the Beta Shares Australian High Interest Cash ETF. What they do is they go out there and find the best term deposits they possibly can. And what you'll see with the shares, if you do look up the chart, is basically it'll look like the edge of a saw. So every month as it goes along, it'll accrue interest, and then it pays it out at the end of the month. And so the share price is ticking up as it accrues, and then it pays it out. So then it ticks up again and pays it out. Now this is can be a decent decent alternative to term deposits for people, because I mean, to get out of this, you just need to sell out. You don't need to break anything. Now, iShares Core Bond ETF is what we use for our exposure to Treasury and government bonds. Then, for a little bit of diversification in the global credit-based securities side of things, for our fixed interest, we are using currently the Macquarie Income Opportunities Fund. But because that's actively managed, it's weighing in at a management expense ratio of 0.49%. So just going forward here, you can see the core growth portfolio breakdown. Right now, you've got Australian and international equities on a bit of an even footing there. Property comes in at 14%. We've then got fixed interest at 19%. We've got cash at 8%. And on total, the management expense ratio from all of those individual holdings averages out to be 0.2% per annum. Now, keep in mind, on top of that, this portfolio, run as a separately managed account, does have a management fee of 0.77% per annum. So when you're thinking about the total cost to you as an end user, you need to put this total approximate MER percentage on top of that, plus the brokerage as well that you'd pay with us. Now, the brokerage is very reasonable. It's a settlement fee of 33 cents per trade, and then a brokerage cost of 0.05% of the transacted value. So when you actually sit down and work that out, it's pretty cheap. So just keep that in mind though when you are thinking about the total cost of running one of these separately managed accounts for yourself. Now, going further here, we'll look at our international exposure. And this is actually, we've recently brought in another Asian exchange traded fund. So these figures here are slightly out of kilter because the Asian exposure has just bumped up in the last 2 weeks. But before that, we had about 47% exposure to the US, and that was through the US S&P 500 ETF at 0.04% per annum there with that management expense ratio. Had a little bit of exposure to the Australian market. Australia makes up about 2% of the global market, so hence why you see it weighing in here at 2% in the portfolio. A little bit of emerging markets, a good chunk there of Europe, Japan at 6.9%, and the United Kingdom. So that makes up our international portfolio. So most people out there are very much Australian focused. Most self-managed super funds have the bulk of their holdings in Australian equities. So generally speaking, and a lot of you would have heard this in the past, you're underweight international. And so why we've put this together, it's to get not to be too clever and be out there hand-picking individual stocks or timing macroeconomic events. What we're trying to do is put together a portfolio to give you broad-based exposure across a wide region around the world. And that's what you get from investing in the InvestSMART International Equities separately managed account. So I did mention I'll talk about how you can actually put them together. So there's a way of thinking called core and satellite portfolios. You don't need to have all your funds just in, say, our core growth or our diversified income portfolio. You can actually mix and blend those portfolios with our actively managed accounts, which are the Intelligent Investor Income Portfolio and the Intelligent Investor Equity Growth Portfolio. They're actively managed by our investment team at Intelligent Investor. They're approximately about 95% fully invested at the moment. And they are actively managing these portfolios to outperform the market. So this is where our real performance is going to come from. So you can actually, if you've got a growth focus, you can blend, say, the Intelligent Investor Equity Growth Portfolio with the core growth portfolio, or you can actually put together your own combination. So I myself, for where I'm at in my investment horizon, I've blended the Intelligent Investor Growth Portfolio, and then I've got a component of the International Equities Portfolio. So I've got that exchange-traded fund-based InvestSMART International Portfolio, and then I've also got the Intelligent Investor Equity Growth portfolio. So I've got my international for diversification, and I've got the equity growth for performance, and I've got a little bit of cash there on the side. So that's how I've used these portfolios to blend it together. So people at home, you might not want to just go straight into the core growth. You might want to use the individual asset class holdings that we have through InvestSMART to actually plug the gaps. If you are low on international, you might want to just have the international one and manage your Australian exposure yourself. If you're low on property, you might want to use the property one, which basically tracks the Australian Real Estate Investment Trust Index. So, talking about these separately managed accounts, just a quick overview of them. They're not pooled investments, so if you go to a managed fund, you'll be buying units in a unit trust and it's all in the one bucket. Now with the separately managed account, it's in the word separately is very important here. You've got your own bucket. Basically, my stocks, I actually am the beneficial owner of those underlying stocks. And so I can see my account, I can see absolutely every single stock that is in that portfolio from the highest weighted to the lowest. I can see all the winners, all the losers, all the dividends that are coming my way as well. I have full total transparency over that. And it also is better. It works out best as well for tax purposes as well. I'm not paying any tax, any capital gains tax on anyone else's gains or gains that I might not have gotten. It's all just based on my account. Now, it's the reason why we do really like these separately managed accounts and why they were our first go-to when we were putting together investment products for our members is because they are really flexible when it comes to income. So you can actually have it set up so when any stocks that you hold pay a dividend, that dividend is swept out directly to an account of your choosing. You can also then have it set up so that on a monthly basis, if you need $3,000 a month or $4,000 or $5,000, whatever it might be, you can to fund your lifestyle, you can have that swept out into an account of your choosing as well. And then you can do ad hoc payments. Or so if you need $10,000 this month and in 4 months' time $15,000, then you just email us and we will take care of it for you. Now, or you can do a combination of all three of those things. So you might have the dividends being paid out into an account of yours and you know you need a certain amount a month to cover your living expenses, and so you can then do ad hoc payments to make up for that shortfall if that's, the dividends aren't enough coming in at for that particular month, because dividend payments can tend to be quite lumpy. So that's why that's one of the main reasons why we decided to use these separately managed accounts. So that brings me to the formal end of the actual presentation. What I'm going to do is jump off my PowerPoint presentation here and just have a look at your questions. I did see a few come through, and a few had been sent through from the previous week as well, where we were going to be doing this, but we had some technical difficulties right at the start. So let's jump in and see what questions have been sent through and see if I can answer them. Now, this one came through from Ian, and I saw this just before we actually started, and I thought it was a pretty good question, so I'll tackle it first. What advantages do LICs have over index funds for retirees living on SMSF pension stream? Well, for a start, there are many, many different listed investment companies, and the bulk of them are all actively managed. So you've got a team, an investment team there trying to beat the market. So for me, that's an advantage. Now, a disadvantage they have is those management teams, generally speaking, come at a higher cost. So you've got a high management expense ratio associated with that. Now, the other advantage I would say is an index fund or any unit trust, as a trust, has to pay out all realised income from the portfolio for that particular year to its members. So what a listed investment company can do, because a company is of course different from an investment trust, it can actually retain earnings and look to pay them out at a later date. So if you go and look back through the history of, say, AFIC, Argo, BKI, Milton, these old LICs that have been around for a long period of time, you can see them what they do through, say, leaner times, like the GFC, for example, because of the ability to retain earnings, they can consistently pay out that dividend and maybe top up the dividend for you if they didn't receive enough dividends that year to sustain their current level. They'll top it up from the dividend reserves and look to so they can really smooth out that income. So for me, that's a real big one when it comes to LICs. Of course, the likes of AFIC and Argo, etc., they're so big that it is very difficult for them to outperform the index or do too much different from the index. The big advantage there is the smoothing out of the income. But of course, for the other ones out there that are actively managed, you can potentially outperform the market, but just don't overpay for them. Herbert asks, if I invest primarily in your core growth product, will you amend the asset classes in the model to rebalance on my behalf, or will I need to add models myself? Herbert, we do rebalance the portfolios for you. So basically, if you invest in the core growth portfolio, then we rebalance for you. So we take care of that. If you invest in, say, 2 or 3 different models, what you can do is choose to either have it fixed or floating. So at the application process, you can say you want it fixed, which means basically once those portfolios get out of sync with each other, we'll then rebalance automatically. Now, if you choose floating, when those portfolios will get out of sync, say one performs really well and the other is becoming less and less of a portion of your portfolio, that will continue to happen until you tell us to rebalance. And that's just a simple form that you can find online and send through to us if you are a client. So I hope that answers your question there. Now, let me see. We've got another question I've just sent through, and it's about to pop up on my screen. But I'll get to Justine's question here. This was from last week when we did try to go live but could not, unfortunately. What do you know about the risk parity diversification process, and how does this differ from what you are suggesting? An example is the all-weather portfolio created by Bridgewater. Justine, I'm not familiar with that portfolio, so unfortunately I can't answer that question. If you would like to get in touch with me, you can send me an email at m.sneddon, that's SNEDDON, @investsmart.com.au, and perhaps I can get some more details and come back to you. So we just had another question pop on through from Aspley. Is it possible to invest as an SMSF? I believe there is an online process. Do you need certified trust deeds? We do not need certified trust deeds or certified ID. We can do all of the identification process and what you might know as anti-money laundering identification process all online. And so you can actually start the application process and go through it 100% without having to send us any paperwork. In some cases where we cannot identify you online, our team will come back to you and give you a call and look to sort that out with you. But 90% of the time, we can go through this without any paperwork needed. Wynard says, how often does your health check update its underlying asset allocations? That's a good question, Wynard. That's every time our investment committee actually formally meet. I believe that's once a quarter. Now, it looks like we have actually run out of questions there. There's no new ones coming through. But if you do have any questions and you haven't sent them through, and maybe you want to talk to us personally, you can send me a direct email, m.sneddon, that's SNEDDON, @investsmart.com.au. And I'm happy to field your questions there, and maybe we'll line up a time just to have a conversation so I can answer them with you. But in the meantime, that's all for me for now. But just a reminder to everyone watching, do tune in on Thursday, I believe at 1 p.m, where I'll be sitting down with Alistair Davidson as we talk about our new hybrid model portfolio that we've just launched. So it's a portfolio investing in anywhere from 10 to 20 different hybrid income securities. So if you are out there seeking yield and wanting some exposure to hybrids but don't know where to start, join us on Thursday at 1 p.m. as we will go through that portfolio and answer all your questions about hybrids. But for now, we'll leave it there, and I'll catch you next time. Thank you.